Most beginner traders blow up their accounts in the first 90 days because they don't have a simple strategy to follow. In this video, I'm going to show you an easy day trading strategy that anyone can use without complicated indicators or guesswork, just a step-by-step plan to start trading with confidence. And if you stick around to the end of this video, I'll show you how to avoid the #1 mistake that wipes out most traders. All right, so the first thing that I usually look for when I get to the charts is going to be some sort of liquidity buildup. So in this particular case, what we can see on the chart right here is the lows down here. So with those lows being equal, that is a level that I want to pay attention to if the market has traded higher, because as the market trades higher, anybody who is long may have their stops, right? Their stop losses down here. Or if traders want to short the market going lower, and if they have sell stops at these lows, then they're going to have orders here as well. And so for those reasons, you have sell stops as well as protective stop losses for longs. All right. So if I'm going to attack that level, I want to have that usually with like a horizontal line of some sort or a horizontal ray from whichever one is the lowest. In this particular instance, when they are equal, that is perfect. When the low on the right is slightly higher, that's even better. But we'll talk about that in a different video. All right. But the point is we want to see a buildup of liquidity. All right, so in this particular example, the highs may not be right next to each other, especially if you zoom into a smaller time frame. But if you were, let's say, to zoom out, you could see that this high right here is followed by a high over here, and it is lower. And you also have a lower high here when the market sold off. So because this high has a lower high on the right, that can be seen as a buildup of liquidity on the upside. So for me, that is going to be a target later for taking a long position. All right, number 2, I'm going to look for an opposing high or low to be taken, right? I want the market to take an opposing high if I want the market to go lower, or to take an opposing low if I want the market to go higher. So here is pretty much the same example that you saw just a second ago, where you have these highs here as well as that other one. And so the market does trade lower, it rallies a little bit, and then it trades lower again, right? So again, if we want higher pricing, we typically want the market to go lower first before going higher. Right? So this low right here was taken here, and that's what we want to see, because traders think or might think that the low has been set with this retracement higher, and they're going to try to long a retracement on, you know, whatever tool that they decide to use, and stops are going to go to that low and a little bit below it, and then you see the market attack that, and that's what we want to see. All right, after that, what we want is a CISD in the direction of opposing liquidity, and that is just an acronym for a change in the state of delivery, or a shift in price delivery if you want to call it something different. But for short, CISD in the direction of opposing liquidity. So we're going to go back to the same chart on a slightly different time frame, but those highs are still up here, right? We saw the market go lower and then rally, and that low is being taken here, right? And again, that's what we want to see. Now we can long down here, or what we can do is wait for a CISD. We can wait for a change in the state of delivery. How can we do that? What we want to look at is either the last down candle, or if there is a series, we want to look at that series of down candles. And when the body of the highest candle is traded through, when we get a close above it, ideally, and we get a return back into it, that is what we want to see. All right. Now I am going to zoom in because I know the example is a little bit thin. So we'll go ahead and do that now. Again, these down candles put together can be seen over here as well. These three down candles together, highest body is here, and the market ends up trading through that here. We get a further extension above that level here, and then the market trades back into it, right? So that return back into the down candle or down candle series, right? That is the entry that I want to take to go long, right? For an attack on opposing liquidity, right? So the market took the low, got traders out, and then we get a change in the state of delivery. So now we know, okay, we have now shifted from the market being bearish, now for the market to be bullish to attack opposing liquidity. So that's why we want to see a CISD in the direction of opposing liquidity. We got liquidity built up, short-term level of liquidity taken, ideally higher time frame too, and then we get that shift towards opposing liquidity. So we want to get in sync with price going higher. All right, if you got some value so far, drop a like on the video. I would greatly appreciate that. Next, we're going to look for a risk reward of 1 to 3 or better. So put simply, we want to have small risk and relatively large reward. So in this particular example, we are essentially risking 1, let's say, for a reward of 3. So the reward is 3 times the amount that we are willing to risk on any particular trade. So an easy example, you can risk 1% to make 3%, not bad. Or if you don't like percentages, if you like, let's say, dollar amount based risk, then you could risk $100 for a reward of $300. Now, obviously, this doesn't include slippage or commissions or swap or taking partials for that matter or anything like that. But just to keep it simple, we want to frame a 1 to 3 risk reward or better, because it does get better than 1 to 3, 1 to 5, 1 to 8, stuff like that. But at a minimum, we probably want to see a 1 to 2, but we want to shoot for a 1 to 3 or better. All right, so going back to our same example, after a shift in the state of delivery, when we trade back into the series of down candles, that can be our long. Normally, the stop can go to the more recent low. There are other ways to change the stop loss. We can make it smaller, but what I have done here is actually just kept it at a 1 to 3 for a run above this high, and we get exactly that. And the market actually overshoots that, but that's not the point, right? The point is, okay, are we trading in the direction of opposing liquidity? Can we get at a minimum 3 times what we're willing to risk? And that is a good example of an entry after the shift in the state of delivery in the direction of opposing liquidity. All right, so what we can look for is 1 minute and 5 minute time frames for entries. So we do want to keep the daily and weekly bias in mind. That's what the weekends are good for, to analyze the weekly chart as well as the daily chart. You don't want to skip that. A lot of beginner traders skip the higher time frames because they think it's too slow. But I'm telling you, if you align yourself with higher time frames, you're going to have an easier time trading. Okay. Now, what we can do on the intraday time frames, I'm not really someone who looks at the 4 hour, but if you want to add that, you can. But for the sake of this video, I'm going to keep it as simple as possible. The 1 hour time frame and the 15-minute time frame, those are going to be good for the buildup of liquidity, right? If I can see some distinctive lows or some distinctive highs, like previous day high and low, something like that, or previous week high and low, if I can look at a 1 hour and a 15-minute time frame to see equal lows, low resistant lows, equal highs, low resistant highs, that's what I want to see. Now, the 5-minute and the 1 minute can also have the same thing there. Price is fractal, of course. But what I want to do is look at the 5-minute and the 1 minute even for the shifts in the state of deliveries. And I want to look at the 5-minute and the 1 minute for entries, right? So when you put that together, what are you going to have? We want to see liquidity buildup on the 1 hour and the 15-minute. And we want to go down to the 5-minute and the 1 minute for entries. Okay, so when you tie those two together, you're going to find some good trading opportunities. Number 6, the best days are going to be Tuesday, Wednesday, and Thursday. Now, that's not to say you can't trade Monday and Friday, but for the sake of this beginner video, what we're going to do is actually cut out Monday and Friday. So the middle of the week, right, the majority of the movement basically is going to be on Tuesday, Wednesday, and Thursday. Again, the middle of the week. Now, if you're an advanced trader or an intermediate trader, Mondays and Fridays are fine too. But this is a beginner video, and you're gonna find really good opportunities on Tuesdays, Wednesdays, and Thursdays, right? So we know what to look for, and now we know when to look for them. Now, we need also to know when not to trade. So number 7 is avoid trading prior to level 3 news events. Now, this is simple. If you go to forexfactory.com, you can throw on a filter that only shows the red folder news. In this particular case, I made this last night, but I'm recording this on August 16th. So this is the following week, right? We have scheduled CAD news, right? CPI on Tuesday at 7:30 Central. And then there's like meeting minutes on Wednesday at 1 p.m. in the afternoon. And then we have some important level 3 news on Thursday, the 7:30 Central unemployment claim. That's something I want to pay attention to. And I don't want to enter a trade right before that. I'm usually not up at 7:30 anyway, but like say, for example, the 1 o'clock meeting minutes here, I probably don't want to trade at 12:45 or 12:30. I don't want to get into a trade just prior to news or some sort of event that may move the market. Now, number 8 is permissible to trade after the level 3 news events, right? Well, there's really no explanation for that. It's just, hey, look, after the news, now we can start looking for opportunities, okay? Number 9, no more than 2 trades per day. Whether it be a win, whether it be a loss, or whether it be a break even. Now, this is important because this is risk management. We don't want to over trade. We don't want to be on a 1 minute time frame trying to be a machine gunner taking 20 trades a day. That is not what you want to do. That is a good way to go on tilt, and that's a good way to lose a lot of money. All right, so what we want to do is limit that to 2 trades per day, no matter what the outcome is. Number 10, we also want to limit our risk. So we're going to do no more than 1% risk per trade. So if we combine that 1% risk per trade maximum with a max number of trades at 2, then ideally we should have a 2% loss limit per day. And if for some reason on Tuesday, Wednesday, and Thursday, if we were to lose 6 trades in a row, then we'd have roughly a 6% loss limit per week if we lose all 3 days in a row. Now, statistically, that shouldn't happen. It can, especially if you get it wrong, or if you break some of the rules that I've already given you here, then yeah, that will happen, but ideally it shouldn't. All right, so we have limited our trade frequency to 2 trades per day and 1% risk per trade. So even if the worst possible outcome would happen that particular week, then your account should not lose, right? Your demo account should not lose more than 6% in that particular week. All right, so what assets are permissible? And it's pretty much everything. I'm an index futures guy, and a stocks guy. I prefer indices, but you're allowed to trade the majors, Euro USD, GBP USD, right? Fiber and cable respectively, AUD USD and NZD, right? Aussie, Kiwi, so on and so forth. And then I know there's a lot of gold traders out there. This would also work for gold and silver as well, if you're into relative strength and stuff like that. That's not for this video, but there's your list. You can do whatever you want. Ideally, indices, majors, and the metals, gold and silver. All right, so again, just for a quick recap, we want to wait for liquidity buildup. We want to see the market then take an opposing high or a low. If we have a liquidity buildup of highs, we want to see the market go lower first. If we have a buildup of lows, we want to see the market go higher first to then go lower. Right? We want to wait for a shift in the state of delivery in the direction of opposing liquidity after the high or low has been taken. Liquidity buildup, take a high or a low, and then get a shift in the state of delivery in the opposing direction of the liquidity. We want to frame a risk-reward ratio of 1 to 3 or better. We want to enter on 1 minute and 5 minute time frames, right? The 1 hour and 15 minute for liquidity buildup, 1 minute and 5 minute for entries. The best days are going to be Tuesday, Wednesday, and Thursday. We don't want to trade prior to level 3 news events. We are allowed to trade after the level 3 news events. No more than 2 trades per day, and no more than 1% risk per trade. All right, and that's it. So you can join us in the Discord. You must be a member. It's only $25 a month. You can cancel it anytime. The benefits are you get the permanent chat access on the live streams. I live stream 4 times per week right here on this YouTube channel. In the Discord, we share ideas, and you get to join the other 190, 200 plus people in there. You get 2 market reviews every week and other stuff that I probably am forgetting. All right. So with that being said, y'all be good, be blessed. Share this video with a friend if you want them to get value as well. And I will see you in the next video.